Chapter 12 is on the cash flow statement. You should have an understanding of the other financial statements. We had the income statement, which was revenues and expenses and net income. We had the balance sheet, which was assets and liabilities and equity. And then we had the statement of retained earnings, or we sometimes call it a stockholder's equity statement. But we haven't talked about the fourth one, which is cash flow. And so I'm choosing to have us talk about that right now after we have talked about the other three. So we need to understand that there's four statements, primary statements in financial reporting that all businesses will have. And for every financial statement period, be it a month, be it a quarter, be it a year, they will have these financial statements. And this chapter happens to be on the cash flow statement. So within the cash flow statement, we will have three primary activities occurring: operating, investing, and financing. And I'm going to refer to this as OIF, O-I-F. Now, why do I do this? Why do I use OIF? Because you need to understand that there is an order. It's like in most things in accounting, it's very orderly, and the cash flow statement is no exception. And so the order is OIF, OIF. And our learning objectives, we need to understand what operating activities are, investing activities, and the accounts, and how they affect cash and financing activities, and how to complete a cash flow statement. There's two methods to completing a cash flow statement: the direct and the indirect method. I'm not going to require you to understand this indirect method. All we're going to do at this point, at this level of our instruction, is understanding what the direct method is. And then it's very important that you understand how to read a cash flow statement and what it shows. And why would it be important for us to have a cash flow statement? Because it's not enough to know that a company is making net income. We also need to know if a company has positive cash flow and if they have cash flow so that they can be a sustained business. And this cash flow statement, it also relates back to the other financial statements, and we will be talking about that. So, one thing, number one, OIF. Operating, investing, financing. It's just one of those things we have to memorize. Operations is, or operating, is what we do for a living. And yes, you've seen this before. Profits, net income, income statement, right? Investing is what you do to be able to make money. And this is not buying of inventory, though. It's fixed assets, and we sometimes refer to these as property, plant, and equipment. And the abbreviation you're going to see later in the semester is PP&E. So if someone's talking about PP&E, they're talking about buying property, plant, and equipment and then using it. And you can think of this as a manufacturing plant buying a equipment, a machine to use in their manufacturing plant. Or you could think of it as the Pizza Hut buying delivery trucks. This is an investing activity. And also, companies sometimes invest in other companies, and this is also an investing activity. These things are long-term in nature. And so a company could use their cash to buy property, plant, and equipment. We would call that an investing activity. A company could use their cash to buy inventory. This would be an operating activity. Now, the last category, so it's OIF, O-I-F, so now we're up to F, is financing. And a financing activity is how they get cash in to pay for things, other than getting the cash from operating. So instead of selling inventory and getting cash in that way, maybe there's not enough cash and they need to buy more inventory. Well, they might go to the bank. And going to the bank, for example, for getting long-term financing, or they may issue stock. This is called financing. So this could be a source of funds for the company. So on 5, we're talking about sources and uses. The easiest way for me to think about these and this terminology is to either go back to journal entries, and we talk about credits to cash. Well, every time we credited cash, this was a use of cash. And then we talked about debits to cash. For example, we might have sold merchandise, or we might have done some other operating activity to get revenue. Well, this would be a source of cash. So you can think of it as your debits and credits. You can think of it as your T accounts. That's another way to think of it. You can think of it as a cash flowing out, or you are giving cash out, or you're getting cash in. Getting cash in is a source, and giving cash out is a use. So this whole cash flow statement is going to categorize these cash flows into operating, investing, and financing, and it's going to show us whether the cash is coming in or coming out of the company. And it's going to be for a period of time, like all our financial statements are. And it's also going to show these non-cash transactions that are significant, and they're going to be just noted, but it's not going to be within the cash flow statement itself. The cash flow statement only has to talk about cash and what's happening with the cash account. So here is one cash flow statement. You notice the top line, like all our financial statements, is the name of the company. The second line talks about what it is. It's a statement of cash flows. And the third line up here on the header talks about the time period. At the very top, what do we see? Operating, investing, financing. That is the order. OIF. And here we say net cash provided, and in parentheses it says used. So if cash is being provided by operations, it will be positive over here to the right. And here we see that it is at 179. This says in millions. This is quite common for a company to do something like this because it makes it easier for the reader to read the financial statement. Rather than saying 179 comma and all those zeros, they say 179, then over here they say in millions. So we have cash being provided by operations, and operating activities are bringing into the company $179 million just in this year alone. In the second line, it says provided or used by investing activities. So instead of buying investments here, they could also sell investments. In this case, they have cash being provided and cash provided or cash being used. In this case, it is in parentheses over here, so the cash is being used up by their investing activities. So used is a credit to cash, so we are crediting cash and we are debiting probably PP and E. We also could be debiting investments, long-term investments. On this one, we have net cash provided, used by financing activities. Now, this is provided, cash provided, so we are debiting cash. Cash is coming in. If cash is coming in and we're talking about financing, it could be from issuing stock. It could also be from taking out a bank loan or a long-term loan. Now, when we go through these things and we add these up, we come up to 167 million. So you would add these two together, you would subtract this one because it is in parens, so it's a negative, and you get 167 million. This is the change in cash, and I'll talk about this cash equivalence in a moment, but it's really the change in cash for the year of December 31st. If our beginning cash was 175 million, and this is off of the balance sheet, or you could also look at the ledger account for the beginning of the year, so it'd be January 1st of 2012, or another way to look at it is December 31st of 2011. It's 175 million. If you take into account the changes, which are positive, then at the end of the year our balance should be 342 million. The 342 million also ties back to the other financial statement. Which one? The balance sheet. So on the balance sheet, when we list out our cash account, we should show 342 million. So over here I have a note. This is OIF. Add up to this number. This is beginning, which adds up to this. This is another thing where order matters. So this is the standard order, the standard way to do the statement of cash flows. I said I'd talk a little bit about what cash is. Cash is currency, so they may have coins and they may have bills, and it may be you may think about Walmart and the cash registers at all the Walmart stores, all the lanes at all the Walmart stores. You'll have currency and you'll have coins in those drawers. You might also think about checking and savings accounts. So in thinking about writing checks, and I think a lot of the examples we've had, I've been talking about cutting a check or buying this or buying that, and this is what you've probably been thinking about, writing the checks. That is another form of cash. And the other thing is cash equivalents, which are short-term investments. We're not going to talk too much about this semester, but for big companies, often big companies have extra cash in their checking accounts, and it can be millions of dollars, short periods of time, and they go out and they buy certificates of deposits, and they buy these with large banks, and they move funds around. And individuals, their whole job is just to handle these surpluses of cash and invest it. So cash equivalents is also for the big corporations included in this cash account. Now, the focus of the statement of cash flows is, of course, on operations, investing, and financing. Operating activities are the day-to-day activities that we have going on with the company. And the best statement that it relates to, I would say, would be the income statement. Investing, again, is buying and selling of long-term assets, and I also refer to these as property, plant, and equipment, or PP&E. Notice that these are buying and selling. So under operating, you could think of revenues, you could think of expenses, one being a cash inflow, one being a cash outflow. With investing, you could also think of buying these PP&E and selling PP&E, because there are times when we need to replace our property, plant, or equipment, and we would sell, and then we would turn around and probably buy something new, making updates to our operations. Now, financing has to do with exchanges with either lenders or with the stockholders. So, again, let's go back and look at this again then. So, operating activities, the best way to think of that is to think of the income statement. Investing activities, buying or selling PP&E, and financing has to do with getting other sources of cash, primarily either going to banks. Large corporations also issue bonds and issue stock. Operating activities relating back to the income statement. Here are some examples then. Collecting cash from customers. Now, this receiving dividends, receiving interest. Why would a company receive dividends or receive interest? Because sometimes the large corporations have investments where they buy stock in other companies, and if a company owns stock in another company, they could receive dividends off of that stock. Likewise, if they own an interest in another company, they could receive interest. They could also receive interest because, again, they have surplus cash, they need to do something with it, and they receive interest from this investment. So the cash can be provided from these ways. Primarily what you're going to see is the collection from customers, and this relates directly back to that income statement, which is the revenue source. We are going to use it up for expenses. think of electricity, and we were also going to use it up, say, from paying our salaries and our wages, paying the income tax. We had income tax expense, interest, we had interest expense. So again, the inflow business here relates primarily back to revenues, and the outflows relates back to something we called expenses. Investing activities. Okay, what would you do with your cash? How would you use your cash for investing? Well, you would buy equipment. You would buy PP&E, you'd buy investments in securities, and how would you get cash in from those things? By selling off the equipment or by selling off those investments. And so you need to categorize each one of these things, and you put them into their proper categories, and here they have listed all these out, and the net effect will show up here. And so they're netting their positives or netting their negatives. These are all uses of cash. They're negatives, and so it shows up as a total negative. Financing. Now with financing, of course, you're going to think about the inflow from the borrowing or the issuing of stock. But the other side of these things is, instead of borrowing, we could pay off our debt. And if we pay off our debt, then that is a use of cash. And also, there's an interesting thing here you have to keep in mind, is not only do we get cash coming in from selling stock, but we can also buy back our stock. This will be in a later class. You'll learn more about this. Or we can pay cash dividends, pay dividends. So paying dividends to our stockholders is a financing outflow. Again, you can go in here and look at this section, and what they're going to do is say, we borrowed long-term debt. That's a source of cash. It's a positive. We paid off our other debts. So we paid off some debt. We borrowed some other debt. And then we issued stock. Netting all these together, you see that we actually have cash coming in from financing of 42 million. There is a relationship between the cash flow categories of OIF and the balance sheet categories. I'm not too in tune with you understanding all of this other than what we have covered just in our previous slides. Investing, again, tends to we're talking about investing in non-current assets. And by non-current assets, we're talking about property, plant, and equipment and long-term investments. And with financing, we are talking about stockholders' equity, and we're primarily talking about non-current liabilities. This business up here about operating and current assets and current liabilities refers back to the indirect method. I am only going to require you in this class to learn the direct method. Now, the relationship between the statement of cash flows. Of course, it relates back to the balance sheet and the transactions there. So the main thing you should know in this class is the relationship between the cash flow and the cash account in the balance sheet. Again, this indirect method is not something I'm going to require you to learn this semester. You do need to know there is an indirect method. And the indirect method looks at the income statement and it relates back to the cash flow statement to the income statement. This is a very important thing. When investors look at a company, they're able to see how the income statement translates into cash flow. In the long run, cash flow and net income are equal, but temporarily they are not equal, and the indirect method will show that difference. Again, you're not required to know this method. You should note, though, that most companies do use the indirect method, and whether you use the indirect method or the direct method, you end up with exactly the same summary cash flow statement. So there's really no difference between the two methods, except that at your level of understanding of accounting, you only need to learn for this class the direct method. The direct method then up here will look at the cash account, and it will go through each transaction, each debit, each credit, and decide, is each one of these line items an operating, investing, or financing activity, and you put each one of those into the proper categories. You also have to determine if it's a source or a use, but this is quite an easy thing. If it's a debit, it increases the balance, so it's a source, and if it's a credit, it reduces the balance, which is a use. So the sources and uses shouldn't be difficult. The main difficulty is putting everything into the proper OIF category. So whether you use the direct method or the indirect method, you come up with the same result. It really doesn't matter. We are going to focus in on this method, which is the direct method, and you are going to go through your cash account and you're going to look at all the transactions affecting cash. Collecting cash from customers, this is a debit. Paying for inventory, a credit. Pay the employers, pay the suppliers, credits. Pay interest, credits. Pay income tax, credit. And so the net change in the cash account from these operating activities is $179 million. They're going to get the same number if they use the indirect method, and you can see how it relates to net income to this number. Net income is $128 million, but cash coming in from operating activities is $179. So this indirect method, it shows the reader of the financial statements net income and cash from operations in the same statement, which is very helpful. That's all it does. You do not need to know this method or how to do it in any way. We are only going to focus in on this method over here, which is the direct method. As I say here, you are only responsible for learning how to create the cash flow under the direct method. Go to your ledger account, classify them as OIF. If they are debit, they're sources. If they're credit, they're uses. And then last of all, you go back and you create the bottom part of the statement, which says the beginning balance, ending balance, and the changes. So what you've done here is with the cash account, you've gone in and you've categorized everything and put them in the proper categories. So operating up here, investing here, financing, beginning balance, changes, ending balance. So it relates back to, directly back to either you can look at it the T account or the ledger accounts. Now, the operating section, then you just take those numbers, put them down here, and then what you do after you complete each section is you add up and subtract the negatives, which are put in parens, to come up with a number. So now we're on to the investing activities, and they purchase equipment, and if they buy equipment and they pay cash, it's a negative, and they also bought some intangibles or other assets here. It might have been the purchase of a trademark. The net effect of this is that they are using up their cash, $54 million in those activities. Now we have some other information that is given to us. When we are given this information, this will help us create our financing section. No dividends declared or paid, so we don't have any cash payments to worry about, so no cash outflow in our financing for dividends. Long-term debt was paid, so that is going to be a use of cash. And we took out some more loans, which is $50 million. And then we issued stock, and issuing the stock is another source of cash for us. So these will all go into our financing section. We put those in, we total them up, and that gets our totals for this section. Now, we can go back to this, and they're saying they're calling this reconciling, And I don't really think we need to talk about what reconciling or reconciliation is at this point, other than to say that this 342 million is the same balance that appears on the balance sheet. Again, operating, investing, financing. They have abbreviated this operating section because they've given us the details in other slides and they can't get it all on this slide. You would have listed out the total cash provided. It'd be net cash provided by operating activities. Above it you would have the detail, just as they have had the detail for the investing and the detail for the financing sections there. Now, they have additional supplemental information that they think is important that should be put in. And one thing which you would put in here for sure is non-cash transactions that are important to the reader. And so these are non-cash. If they are non-cash transactions, you would list them down here. They're putting in taxes and interest, which is a requirement, and they're listing it as a separate area. I would refer to this as note. This is a note that is attached to a financial statement. Just like when you're writing a term paper and you want to put in a footnote. This is a footnote disclosure. That's what it is, just a footnote that explains further this activity which is occurring, that is either a non-cash activity, which is the 2 up there, or the cash paid for taxes and interest. Just something that's added at the bottom. The thing about it is operating cash flows for a company have to be positive for the company to be successful. If in the long run you don't have positive cash flows, what do you have to do? You have to file bankruptcy because you don't have cash. Your employees are not going to work forever without being paid cash. They will leave you. Your vendors will not continue to supply you with inventory for you to sell if you can't pay it. Your electricity is going to be turned off if you don't pay your electric bill. So over the long run, these cash flows have to be positive. Now temporarily it can be negative, but in the long run it has to be positive. The thing here is you can't go out and you cannot create cash by selling off your equipment or by taking out loans unless you have operating cash over time which is positive. Not only does it need to be positive, it needs to be growing, because if operating cash is growing, it means your company is successful. It's another measure of success. A good company has operating cash flows and net income also that are very close to the same thing, because we want cash and we want it now. We want the cash now. If you don't have cash now, you're going to end up going to the bank and borrowing money. Now, investing, what do we like to see there? Well, investing is buying property, plant, and equipment. So if the company is growing, it has to buy property, plant, and equipment. It just has to buy property, plant, and equipment. That's how it grows. So we would like to see some cash being used to buy property, plant, and equipment. Now, if it has cash flow coming from this and it's positive, it could be they're selling off their assets or they're closing down their business. That's a bad thing. So it's not really possible to just look at the cash flows, the financing cash flows, to see what's going on. Instead, what you need to do is look at it and see what the company is doing with this financing cash flow. So if they're issuing stock, what are they doing? Is their company growing? You're going to see that in investing. If they're issuing stock because they don't have enough operating cash, this is another issue. It means they're trying to hang on, but their company is really failing. There are also patterns to this cash flow that when you look at a cash flow statement, you're going to see. These are the phases of a business, and I think you should think of this as IPOs, companies that are just initially starting their businesses, initial public offerings just incorporated, just starting as a corporation. And what you're going to see with that is they are trying to grow their company. So they're having to go out and get financing so that the company can grow. And their operations are just beginning to pick up, and so it's just starting to grow here. And investing, it can be a little higher than this, or it can be in this area. And then it goes through a growth phase, and in the growth phase, what you see is operations are just booming. It's just booming operations, a great growth curve here happening. When the company matures, their operations slow down. They have less need for financing because the company has ample growth, it's very strong, has a lot of cash flow coming in. You may see that they have too much cash, and so then they start investing. They start using their extra cash maybe to invest in other companies. And when a company starts declining, what happens? Operations also goes down. Of course, this makes sense. It's a declining phase of the company. They are using their extra cash that they've had, and they're starting to invest in things here, but operations mainly going down. And this translates to the cash flow statement. And so the positive area is up here where we have positive cash flow, and negative down here you have negative cash flows. So this chart also explains that a company's cash flow and how the cash flow statement looks may relate back to the company's phase, the phase of the company, at what point in development the company is at. That may relate back to the operating, investing, and financing patterns that you see in the company.